All right, hello everybody. Welcome to Korean Atlanta Mentorship here with another video reacting to someone with $106,000 in nursing student loans for nursing. So let's see what's up and then also simulate debt payoff using this situation like we always do. So let's see what's up with the video first.
You went $106,000 into student loan debt, in which nursing does not have to be this expensive.
For good
Could've done this
BSN
for the-
programs,
Oh, shut the fuck up.
here's the
Nursing
thing.
you can get from anywhere and do so
you
well.
have to remember, it used to be really hard to get nursing jobs.
That's not true.
No, because if they saw that you went to certain schools, they were more likely to choose you based on your resume.
Nursing has
BSN.
been an underemployed industry
here's
for
the
a
thing.
long time.
Certain hospitals don't hire people unless you have a BSN.
You could have got nursing community college and you would have made good money. My family is nursing industry to the core, cousins, all the shit. None of them went to anywhere that's been known. It was all community college. And they make great money.
Yeah, she has no response for that. I don't think I don't think anybody really cares where you went to college, right? Unless like you're trying to get a job at a prestigious law firm or something like that. And yeah, so $106,000 in student loans and well, let's try to simulate that debt payoff using something called the velocity debt cannonball method. We used to call it something else, but if you do a quick Google search, there was regulatory action taken against another YouTuber for using the word banking, and they were not a bank, and they were selling debt payoff services, right, or educational services. So we're trying to transition away from it, but we're going to simulate debt payoff, and I already know somebody who makes $175,000 a year as a nurse. Yeah, $175,000 a year. So if you make $175,000 a year, that's about 10 grand a month after tax. And then let's assume that we have eight credit cards, an auto loan, and that $100,000 student loan. And I think if you can take alternatives like community college, I think it'd just be much cheaper. I think community college in California is like 5 grand a semester if you go to Wright Community College. And so I don't think you have to get over $100,000 in student loans for a degree that you're not gonna really you don't need to get that degree at a specific school, right? All right, and then we have a mortgage here for 270,000 for 6.4%, as well as our personal expenses, food, gas, insurance, and all that other good stuff here. So this is what we're gonna do. We're gonna copy and paste this because the whole point of this velocity debt cannonball method, or we could all call it kind of like something like the artist formerly known as Prince, or the method formerly known as velocity banking. The whole point of it is that we're just not going to save any money. So this negative $37 here is actually, we're just going to turn it to zero. Okay. And next, we're going to increase our cash flow by just shuffling some debt into something called a line of credit. So what's a line of credit? Basically, it's a financial tool where you can borrow money, pay it back, and then use it over and over again. So let's say for this example that we have access to a $150,000 line of credit. Now, would we realistically be able to get a $150,000 line of credit when your cash flow is a negative? No. Why? Because banks don't lend money to people who need it. And when the bank sees that you need money, automatically it's like red alert, right? Because according to them, people who need money are bad people who won't pay you back, right? And you have to understand the bank's business model. The bank is looking for people to leech off of and make money off of them. Interest, right? So if you're, let's say, a leech or a vampire, you're looking for people with lots of blood in their system and who haven't had their blood taken out by other leeches, aka other banks. Whereas if you have too many debts, and this is all in your credit report, right? They say, oh, you've had your blood sucked or leached by the other banks, and you have a ton of debt, so therefore we can't give you a line of credit. Now, realistically, I've done realistic scenarios where people, specifically one that I'm really proud of, where one person had, I think, like 22 debts and $4 left over, and then $5,000 of income a month. And we went through that scenario. And that's in my 99 cent YouTube channel membership. So if you want to go through that, right? Just join the YouTube channel membership, and you can see that video. It's called 22 Debts, with the method formerly known as velocity banking. All right, so now what we're going to do is just use something called the cash flow index. So if you don't know what the cash flow index method is, it's just basically a formula of the debt amount divided by the payment, which is $5,000 divided by 175, right? And so it gives you this arbitrary number, and you think of this number as like a ranking system, right? So you'll notice here we have up from 28 up to 159. Now, what does this ranking system actually mean? Well, it means the lower the number, the more bang you get for your buck for paying off the debt. Okay, so that's really what it means. So we don't want to pay off this $270,000 mortgage first, because we need to give someone 270,000 in order to get only $1,600 back into cash flow. Whereas if we pay off this 30 grand and this 27 grand, so 57 grand, we get 1,800. So we're getting more bang for our buck in terms of cash flow by paying these debts off first, right? So what we're going to do is we're just going to assume that we have the ability to shuffle some debt into a line of credit. And now, realistically, you won't get a free and clear line of credit. Like I said before, banks don't lend money to people who need it, because people who need money are bad people who won't pay you back, right? So this is $137,000, and let's just move that into a line of credit, right? 8%. We'll assume it's like a home equity line of credit. And guess what happens just by simply moving this debt, this credit card debt, into a line of credit? Oh my goodness. It's like a credit card balance transfer, and these payments magically go to zero. And so we literally turned negative $37 into $4,412.90. Say what? And we literally, okay, we literally did not increase our income. Okay, so income is exactly the same. We just shifted our expenses, so the expenses are still there, but somehow this negative $37 turns to $4,412.90. Now, the final step is we're not going to save money. So we're going to dump all of our income into the line of credit, take our expenses out, and then rinse and repeat over and over again. So let's go ahead and do that. And then so now I'm going to just do this plus one. And then we'll take the previous month's balance, previous month's interest, minus our cash flow, 4412.9. And then what we're going to do is take the average daily balance, right, multiply it by the interest rate times 0.08, and then divide by 12. And then after every single month, you'll see the balance go down by the cash flow, along with with some interest added on top of it. So you'll see that, whoa, started at negative 37 dollars as a nurse, and now we're rocking it, right? So let's go ahead and do that, and then we see that in month what month are we at? We are month 35, so right 1 month below the 3 year mark, we pretty much paid off the debt. So that's 35 months, and then that's 137K. And then I'm going to go ahead and copy and paste, right? Whoopsie. Copy. What am I doing? Oh man, what's wrong with my mouse? Copy and paste. There we go. All right, and then now we have three more loans: auto loan, student loan, and the mortgage. And then let's just put in the current month. So we have this loan calculator right here, what the current cash flow index is. And now what we're going to do is copy, okay, we're going to copy the balance of the loan, of the car loan, because it has the lowest cash flow index, right? 24. We move it into the line of credit, so that's going to be plus 10873.51. And then what we're going to do is this is now going to be a zero. And then this is going to be $4,862.11, right? So now let me just kind of go back here, and I'm just going to do this. So 4862.11. And then we see that in 38 months, or in 2 more months, it's pretty much paid off. So let's just kind of go here. So 38 months. and then that's going to be 137 plus 25, and then that's going to be 162K. All right, so now student loans, right? So let's figure out what the balance of the student loan is at 38 months. So now I just do 38, 38, and then this is going to be 0. So we have about 80,000 left in our student loan. So this is a 6% interest student loan, 80,000. Cash flow index is 67. So usually they say if it's below 50, pay it off. But it's okay. We're going to use a method called chunking. So what is chunking is you're just taking a piece of the loan, moving it to line of credit, and then rinse and repeat over and over again, right? And why do we do this is because if we move the whole thing into a line of credit, we're actually going to end up paying more interest than we have to. So so that's why we do something called chunking, which is moving a piece of the loan into the line of credit. And if the interest rate is a substantial difference between the loan and the line of credit, and you're moving the whole thing in, you're going to end up paying a lot more than you have to. All right, so let's go ahead and just do this. So let me do the student debt here. So it's $108,000 student loan. Actually, let me just do this, and I'll just reset all the information. So what's our monthly income? It should be about 10,000. 10,250, 10,250, and then our living expenses is everything except for the loan we're trying to pay off. So it's going to be these two right here. So let's see what that amount is. So this is going to be 4188.87. So 4188.87, and then we'll just do $11,000 chunk, and then this is going to be a 10-year loan. What's the interest rate? Interest rate is 6%, 108,000. What's the payment amount? Payment amount is 1199.02. So 1199.02. And then the current balance is 80495.44. So 80495.44. And then we see that it gets paid off in 1.2 years. So let's go ahead and put that in the loan here. So 38 divided by, no, 38 plus 1.2 times 12. That's going to be 50, we'll say 53 months, right? 53 months plus 262K. And then the last one is the 30-year mortgage. So let's just do this right here. Just got to reset it now. So as I said before, the expenses is everything except for the loan you're trying to pay off. So this would be just a 2,500 here. So 2500, and then that's going to be a 30-year mortgage with the payment amount of, what's the payment amount? 1688.87, 1688.87, and then what's the interest rate? Interest rate is 6.4%. Okay, original balance is 270. And then the current balance is, let's just take a look at what month we're at month 53. So 53. So it'll be 254,803.62. 254,803.62, right? And then now we see that as a nurse, we paid off our mortgage in 3.1 years. Okay? So now let me just kind of go back here. It's going to be 53 divided by 12 plus 3.1, and that's going to be 7.52 years. We are completely debt free, right? Even with that $100,000 loan, assuming that we make $175,000 a year, and a nurse's salary can vary. I heard they make as low as $70,000 to as high as $200,000, right? And the nurse I know makes $175,000. Okay, well, that's it for today, folks. This is Kraylanta Mentorship. So let me just do 00 right here. Wow, 3 videos in one day. What a miracle, right? Anyways, all right. Well, have a great day, everybody, and I'll see you all in the next video.